All right, let's dive in. Today we're taking a deep dive into Godrej Consumer Products Limited, or GCPL, as most folks know them.
Yeah.
You know, the company behind everything from soap to bug spray, and, well, even some products for those more romantic moments. And we've got a ton of great info to work with today. Company reports, stock filings, and even some juicy bits from their latest earnings call.
GCPL is a fascinating company to cover. They hold a pretty dominant position in their emerging markets. They reach over 1.4 billion consumers. That's a massive market with a lot of potential, but it also comes with its share of challenges, especially when you consider the current economic climate.
Yeah, it's like trying to navigate a ship through a hurricane right now.
Yeah.
And speaking of rough seas, their third quarter results are, well, a bit of a mixed bag. They posted a 6% organic sales growth, but that's mainly thanks to their international business. Back here in India, the standalone business saw flat volumes, just 4% sales growth.
Yeah, things get a little interesting when you start to peel back the layers. Rising palm oil prices are eating into their profits. The insecticide season wasn't as strong as expected. And there are signs that urban consumers are starting to tighten their belts. Makes you wonder if this is just a temporary blip or a sign of bigger economic trouble brewing.
Hmm. Yeah, some worrying signs for sure, but there are some bright spots too, right? Air fresheners, laundry detergent, and even their sexual wellness products are all doing quite well.
Exactly. And then there's Goodnight Agarbody, their incense stick brand. It's gaining market share like crazy. But here's the thing. Almost all incense stick brands in India are technically illegal. Except for GCPL, they found a way through the regulations and secured a unique advantage.
Wait, illegal incense sticks? How did that happen?
That's a bit of a long story. Basically, GCPL worked with the government to meet specific safety and quality standards, standards that other brands haven't been able to replicate. And this gives them a huge edge in a market with huge cultural and religious significance.
Wow, that's fascinating. It's a good reminder that sometimes understanding the cultural nuances of a market is just as crucial as the financials. But let's get back to some of the essentials, like soap. With prices going up everywhere, consumers are definitely feeling the pinch. And GCPL is planning yet another round of price increases. That's a bit risky, isn't it?
It's a tough balancing act. If they go too high, they risk losing customers to cheaper options. But if they don't raise prices enough, their profits will suffer. It's a gamble, but they're betting that consumer loyalty will win out.
So it's a calculated risk. Speaking of risks, let's look at their international performance. It's a real mixed bag with some big wins and some areas that need work. Indonesia is killing it, 6% volume growth, 9% revenue growth, and they're even expanding profit margins there. Their shampoo hair dye and those pocket-sized air fresheners are flying off the shelves.
Yeah, they've really tapped into the Indonesia market. They understand local preferences, and they're delivering products that people want. Their approach in Africa is a bit different, though. They've decided to focus on profitability over market share, which means they're maximizing earnings from their existing customer base rather than chasing new customers aggressively. Seems like a long-term play, but time will tell if it's the right strategy.
And then there's Latin America. Explosive growth there, though we should remember they're starting from a smaller base. Still, it's a positive sign. But before we wrap up this part of our deep dive, we have to talk about GCPL's sustainability efforts. They've secured a spot on the prestigious Dow Jones Sustainability Index, ranked among the top 3 FMCG companies globally, which is pretty impressive.
Absolutely, and this is more than just a feel-good story. Investors are really starting to prioritize companies with strong ESG practices. GCPL's commitment to sustainability could be a real secret weapon. It could attract investors and help them stand out in a crowded market. They've committed to making a third of their products greener than they were back in 2020, and they're aiming for net zero emissions by 2035.
So we've got a company facing some serious challenges in their core market, but they're also showing incredible resilience and innovation. They're betting on rural India, holding steady in urban areas, and making waves internationally. And they're even outperforming some of the biggest names in the industry when it comes to sustainability.
It's a really interesting mix of strengths and weaknesses. Definitely a company to keep an eye on.
For sure. But we're just getting started, folks. In part 2, we're going to roll up our sleeves and get into the nitty-gritty of their financial statements. We'll decode the numbers and uncover the hidden stories they tell. So stick around. Things are about to get really interesting.
All right, welcome back to our deep dive into Godrej Consumer Products. Time to put on our detective hats and crack open those financial statements. But don't worry, we're not going to drown you in jargon. We'll keep things nice and clear, even if you don't have a finance degree.
You can think of financial statements like a company's health checkup. They give us a glimpse into their vital signs. show us how well they're managing money, generating profits, and handling debt. So let's start with their revenue, basically the total money they made from selling their products. In Q3 FY25, their consolidated revenue from operations was a solid 3,749.11 crore. But remember, a big part of that growth came from their international business. Right, their standalone business in India, which doesn't include overseas operations. That saw revenue from operations at 2,237.15 crore. It's a 4% growth year on year, which sounds decent, but remember, their volumes were flat, meaning they sold roughly the same amount of product but made more money because they raised prices.
Exactly. And that strategy of raising prices is partly due to those rising palm oil costs we discussed. Palm oil is a key ingredient in many of their products. Soap, hair dye, you name it. So when the price of palm oil goes up, so do their costs.
It's a domino effect then. Higher input costs lead to higher prices for consumers. But what about their other expenses? Surely it's not just palm oil they're spending on.
Of course not. There's employee salaries, advertising, finance costs. And one thing that jumps out in their financials is their advertising budget.
Yeah.
They haven't cut it back significantly despite all these cost pressures.
Interesting. A lot of companies would slash marketing when things get tight. Why do you think GCPL is holding steady on advertising?
It suggests they're thinking long-term. Building strong brands requires consistent investment even when times are tough. They're betting on that brand presence to help them bounce back when the economy recovers.
It's like they're saying, we're not going to let a little economic turbulence throw us off course. We're in it for the long haul.
Precisely. Now let's look at their profit before tax, essentially the money they earned before paying taxes. For their consolidated business, it came in at 681.70 crore. But here's the catch. That's actually a 14% decline compared to last year.
So their revenue is up, but profits are shrinking. That really shows how cost pressures and that slowdown in urban spending are impacting their bottom line.
Right, and their standalone business in India is facing even bigger challenges. Profit before tax there and dropped a significant 28% year on year.
Ouch, those numbers definitely tell a story. But it's not just palm oil and slowing demand in India that are impacting their results. Remember that hyperinflation situation in Argentina we mentioned?
Yes, that's another factor complicating things. Hyperinflation means prices are skyrocketing, making it really tough to plan and predict future performance.
So a whole bunch of external pressures they have no control over. It's like trying to solve a puzzle where the pieces keep changing shape.
Absolutely adds another layer of complexity to their financial analysis. Now, let's shift gears and look at some key ratios. These give us a deeper understanding of their financial health.
Okay, I'm ready for some ratio analysis, but before we dive in, can you remind us what these ratios actually tell us? I know they're important, but they can feel a bit like a secret code sometimes.
Think of ratios like financial fitness indicators. They help us assess a company's strengths and weaknesses by comparing different aspects of their financial performance. For example, the debt-to-equity ratio. It tells us how much debt a company is using to finance its operations compared to money invested by shareholders.
So a high debt-to-equity ratio means they're relying heavily on borrowed money. Could be risky, right? Especially if interest rates climb or the economy takes a hit.
Exactly. It's like carrying a heavy backpack while climbing a mountain. The heavier the backpack, the tougher it is to reach the top. For GCPL's standalone business in India, their debt-to-equity ratio is a pretty comfortable 0.31. This means they're not overly reliant on debt, gives them more flexibility.
That's good to hear. Suggests they're managing their debt responsibly. Especially important in these uncertain times. What other ratios should we be paying attention to?
Another important one is the current ratio. Measures a company's ability to meet its short-term obligations. Think of it like a fuel gauge for a car. High current ratio, plenty of fuel. Low current ratio, running close to empty. GCPL's standalone business has a current ratio of 1.0.
So not overflowing with cash, but not about to run out anytime soon either. Sounds like they're finding that balance again. Seems to be a recurring theme this quarter.
Exactly. They're not taking on excessive risk, but they're also not hoarding cash. Now let's move on to some turnover ratios. These tell us how efficiently they're managing their assets.
Turnover ratios, I'm all ears. What secrets do they reveal?
These ratios help us understand how quickly a company converts its assets into sales. For example, the debtor's turnover ratio, also called the account's receivable turnover ratio. It measures how fast they're collecting payments from customers. Higher ratio means they're getting paid quicker, which is good for their cash flow.
So it's like a measure of how good they are at getting people to pay their soap bills on time. I'm guessing a low debtor's turnover ratio would be a red flag then, suggesting they might struggle to collect payments.
Exactly. Could mean they're giving credit to customers who can't pay,
Ugh.
or they're just not efficient at collecting what they're owed. For GCPL's standalone business, their debtors turnover ratio is a healthy 16.16 times, meaning they collect their receivables roughly every 22 days on average.
That's pretty efficient. Shows they have good credit policies and are managing customer relationships well. What about their inventory? How quickly are they moving product off the shelves?
That's where the inventory turnover ratio comes in. It tells us how many times a company sells and replaces its inventory in a given period. A higher inventory turnover ratio usually means they're selling products quickly and efficiently. GCPL's standalone business has an inventory turnover ratio of 12.27 times.
Sounds good. Means they're not sitting on piles of unsold product, which can tie up cash and lead to spoilage or obsolescence, especially in the fast-moving consumer goods industry.
Exactly. They're keeping their inventory lean and mean. Helps maximize efficiency and minimize waste.
So we've covered debt management, short-term liquidity, and asset efficiency. What's next on our ratio adventure?
Now it's time to talk about profitability, arguably the most important measure of a company's financial success.
Ah, yes, the bottom line. The ultimate test of whether a company is making money or losing it. What profitability ratios should we focus on?
Two key ratios are the operating margin and the net profit margin. The operating margin tells us how much profit a company makes from its core operations, before things like interest and taxes. It measures how efficiently they manage costs and generate profits from their daily business activities. GCPL's standalone business has an operating margin of 22.7%.
That's pretty healthy, especially given those cost pressures. Shows they're doing well at controlling costs and maintaining pricing power, even in a tough environment.
Exactly. But the net profit margin tells a slightly different story. This ratio considers all expenses, including interest, taxes, and one-time charges. Gives us a clearer picture of their overall profitability. Their net profit margin for the standalone business is 15.3%.
So their core operations are running smoothly, but other factors are eating into their overall profits. Shows why it's important to look beyond just one or two ratios. You need the whole picture to understand a company's financial performance.
Absolutely. Financial analysis is like detective work. Gather all the clues, put them together, and then draw your conclusions.
Well, we've certainly gathered plenty of clues about GCPL's financial health. They're managing their debt well, keeping inventory moving, and making solid profits from their operations. But those cost pressures and the slowdown in urban spending are definitely having an impact.
Great summary. But the story doesn't end there. In Part 3, we'll explore their growth strategy, sustainability initiatives, and how they plan to navigate these choppy economic waters.
Sounds like things are about to get even more interesting. Stay tuned for the final chapter of our GCPL saga. All right, we're back for the final part of our GCPL deep dive. We've dug into their financials, but now it's time to step back and look at the bigger picture, their overall strategy.
It's like we study the ingredients, now we get to taste the final dish.
Exactly. So what's the flavor profile of GCPL's strategy? What are the key ingredients they're using to cook up success?
Well, one ingredient that really stands out is their focus on rural India. They're making a big bet on this market. Consumption is still relatively strong there, and there's a ton of untapped potential.
It's interesting. Many companies focus on urban areas first, but GCPL seems to be going against the grain. Why do you think that is?
Well, they already have a strong presence in rural markets. They've spent decades building relationships with consumers and retailers in these areas. That gives them a huge advantage over newcomers. Plus, incomes are rising in rural areas, so there's a growing demand for consumer goods. Creates a massive opportunity for companies like GCPL.
So it's a mix of existing infrastructure, rising incomes, and a deep understanding of the rural consumer. Makes sense. But they're not ignoring urban markets completely, are they?
No, of course not. They're hoping for a rebound in urban spending, but they're also being realistic about the challenges. Those headwinds we discussed earlier are still out there.
Right, so they're hedging their bets, not putting all their eggs in one basket. But speaking of diversification, we need to talk about their sustainability initiatives. They're making some pretty bold moves in this area, from reducing their carbon footprint to creating more eco-friendly products.
Absolutely. Their sustainability strategy is another key ingredient in their success. Like we talked about, investors and consumers want companies to operate responsibly and sustainably. GCPL seems to be ahead of the curve here. Their commitment could really set them apart.
It's like they're saying, we want to be a company that not only makes great products, but also makes a positive impact on the world.
Exactly. And their efforts are being noticed. Remember, they earned a spot on the Dow Jones Sustainability Index. That's a big deal. It shows investors are serious about ESG.
It's like winning a gold medal for sustainability. But let's be real, these initiatives can be expensive. How is GCPL balancing these investments with their need to stay profitable?
That's a great question, and it's a tough balancing act. In the short term, some sustainability initiatives might need upfront investments, and that could impact their profits. But in the long run, these investments can lead to cost savings, better efficiency, and a stronger brand reputation, which ultimately boosts profitability.
So it's a long-term play. They're investing today to build a more sustainable and profitable future.
Exactly. They're betting that doing good is good for business. And so far, it seems to be working.
So they're tapping into rural growth, managing urban challenges, and embracing sustainability. It's a multi-pronged approach, but are there any weaknesses? Any chinks in their armor?
Well, one potential risk is becoming too reliant on price increases to drive revenue growth. Remember, their volumes were flat in India. That suggests some consumers might be pushing back against higher prices. If they keep raising prices, they risk losing market share to competitors who are willing to compete on price.
It's a game of chicken. How high can they go before consumers switch to cheaper options?
Exactly. It's a delicate balance. Another challenge is that their sustainability efforts, while admirable, might not resonate with every consumer. Some might not want to pay extra for eco-friendly products, or they might not fully grasp the value of sustainability.
A reminder that even the best strategies have their blind spots. But overall, GCPL seems to be in a good position for the future. They're adapting to changes, embracing innovation, and taking a leading role in sustainability.
They're constantly evolving and pushing boundaries. It's how they thrived for over a century, and it's likely to keep driving their success in the years to come.
Well said. So, as we wrap up our deep dive into GCPL, what are the key takeaways for our listeners? What should they be watching for?
Keep an eye on palm oil prices. They could really impact profitability. Also, watch how their strategy in India unfolds. Will they manage that balance between rural growth and urban revitalization? And lastly, pay attention to how their sustainability initiatives develop and whether they resonate with consumers and investors.
Great points to consider. But here's a final thought for our listeners. GCPL's journey reflects the challenges and opportunities across all emerging markets. They're dealing with economic uncertainty, rising costs, changing consumer preferences, but they're also embracing innovation, technology, and sustainability.
It's a reminder that even in tough times, companies can not only survive, but thrive by adapting, innovating, and creating value for everyone involved.
That's a perfect way to wrap things up. Thanks for joining us on this deep dive into the world of GCPL. Hope you enjoyed the journey and learned something new.
It was a pleasure diving deep with you.
And to our listeners, keep exploring, keep learning, and keep those deep dives coming.